Welcome back, Money Fitters, to another episode of Understanding the Language of Finance. This week, our secret word is balance sheet. Okay, well, maybe that's 2 words, but stick with me anyway. As always, the mission of my channel is to facilitate the conversation between a business owner and a business using the language of finance. And who else could I rely on to help make these strange terms a little more approachable than Wayne and Garth? I would imagine you're wondering what in the world Wayne's World has anything to do with you, your business, and the balance sheet. I've got to tell you, I actually love this metaphor for a balance sheet because your balance sheet is telling the lifetime story of you and your business, right? So let's look at Garth. Garth represents our business owner in this scenario, right? And he's driving around his entire business. He's got his asset in the front, his best bud, Wayne, right? And he's got some liabilities he's towing around in the backyard. But as I recall from the movie, these guys in the back seat actually help them set up for their gigs. So it's just like your business, right? Your assets, your best friend, perhaps it's a building, some equipment, the balance of your checking account. And then you've had to incur some liabilities in order to build your business. The guys in the back seat. Maybe you borrowed some money from your mother in order to start the business. Maybe you had to borrow some money from the bank in order to buy a van or the Mirthmobile or your building. It's just the story. It's the story of your assets, the stuff you've built, your liabilities, the stuff that you've had to borrow maybe or do in order to build your asset. And the last piece is the lifetime value that you've created, your equity in the business itself. So I hope when you review your balance sheet, you think of Wayne and Garth. And now we're going to delve into that a little bit more. Unlike a balance sheet that gives you all of the income and expenses over a given period of time, let's say a week, a month, or a year, a balance sheet takes a snapshot, all of your assets and liabilities on one particular day. Plus, it also accumulates all of the value that you've generated inside of your company over its lifetime. Welcome to Schwing Enterprises. This is Garth's company. Take a quick tour. I thought I'd start by explaining the difference between a profit and loss statement, just real high level, nothing too deep. A profit and loss statement is a statement people love to look at. It's got account types on it like sales, your cost of goods sold. It includes your expenses, bottom line's net income. Usually I hand out a profit and loss statement and people go like this, right? They look right at the net income. A profit and loss statement is the financial activity given a period of time. I just said that a minute ago, usually a month, a quarter, or a year. Balance sheets are different. Balance sheets are usually at one moment in time. The accounts you'll see on a balance sheet are things like checking account, equipment, loans, and equity. The questions that can be answered by a balance sheet would be a question like, hey dude, how much money is left in our checking account, right? That's the question a balance sheet can answer. A profit and loss statement can more likely answer a question like, hey dude, how much did we spend on those Alice Cooper concert tickets? So both reports are very important. Both provide valuable information, and you've got to know how to read each one. So I'm still laughing that it actually says Schwing Enterprises on a PowerPoint that I'm reviewing. But it's COVID, right? What else are we going to do besides entertain ourselves? So here is Garth's balance sheet for Schwing Enterprises on October 31st, 2020. We've got assets on one side, liabilities and equity on the other. You will see that the totals on the bottom of each side, they equal each other. A balance sheet balances, so that's kind of a handy tip. I've seen ones that don't. It means there's something wrong. The types of accounts you will see on the asset side. In this particular case, we've got Garth's checking account. We've got the Mirthmobile. We also have some equipment and some buildings. These are the things owned by Schwing Enterprises. On the other side of the balance sheet, you will see things that Schwing Enterprises owes other people, right? That's the liabilities part. I'll go over that In this case, it's the credit card, vehicle loan, assuming on the Mirthmobile, a small equipment loan, and the mortgage on the building. The total of those liabilities is just over $137,000. So the equity or the value that has been built inside of Schwing Enterprises is the asset value of about $254,000 minus the value of the total liabilities, which is $137,000. You get an equity position for Garth, assuming he's the only member of this company, the only owner, of just over $116,000, right? So this is a good thing. He's built value inside of his company. So let's look at what it might look like if it were a different situation. This is Schwing Enterprises over leveraged. Leveraged is just a term meaning debt, right? I kept the asset values the same. We saw these before, $254,000. But let's look at the liabilities and equity. Let's say Garth got a little fired up with a credit card. He's up at about $25,000, concert tickets, food, whatever else he's spending it on. The value of the loan for the car is the same. The equipment loan is the same. But the mortgage value in this case is much higher. It's the same value of the building. So let's say perhaps he decided to buy the building 100% of its value and is only paying interest. I've seen that happen before. So the balance of the mortgage is the same as the balance of the building. He's got no equity at all. So when you look at the total equity position, we're looking at the total liabilities, in this case, of $261,500 against the total asset position of $254,000. When you subtract the liabilities from the assets, we've got negative equity. In this case, it's almost $8,000. So that's the difference. When you're a business owner, you want to make sure that your balance sheet looks much more like the first one, where Garth was building a positive position, positive value, as opposed to the second, where he is not. So why does all of this matter, this balance sheet talk? I guess, why does anything matter? We could be here for hours. But in this particular case, I imagine what Garth is hoping to do, maybe someday he'll sell Schwing Enterprises. Maybe he'll pack up the Mirthmobile with Wayne, ride off in the sunset, eating all the crawlers they would hope to ever eat. That wouldn't be so bad, would it? And I hope as you nurture your business, you're able to also build your balance sheet, build value, sell out to a great retirement if that's what you choose to do. Meanwhile, I hope everything in life before you is excellent and I am not worthy. MoneyFit, MoneyFit, understanding the language of finance. Party time, excellent.